This is Mike Rixey. I am the lead options instructor for NetPicks. Wanted to jump on here live today just to review our trading week from this past week. Markets are closed here today for Good Friday, so hopefully you all are enjoying your day off away from the markets. It's been a wild ride the last few weeks, so really nice to have a little bit of a break here, but definitely looking forward to what the market's going to give us next week. I think we're going to be in a very active environment for the months to come. We're going into an earnings season here over the next few weeks. So we're going to head into an election cycle later in the year. And of course, we've got all of the uncertainty with the coronavirus. So a lot to talk about here today. I'll review some of our trades that we've covered in the last couple of weeks in these live sessions. I know some of you have been tracking along with those trades, so I'll take a closer peek at those. Let you know how we plan on handling those. We've closed out of a couple of trades here over the past week. We're also going to take a look at a new trade setting up potentially for Monday. So as always, if you have any questions, feel free to type those in. I will get to those as they come in. So let me go ahead and zoom on over to the charts. Let me turn my webcam off here briefly so you can see my charts in more detail. All right. So what we're looking at here, and actually let me shrink down the sidebar here as well, just so you can see this data in as much detail as possible. This is just a simple daily chart of SPY. I always like to start out with this chart because it helps me form a big picture view of the market. A lot of us get distracted. There's so much information hitting us throughout the week, right? Whether it be through financial media, CNBC, Fox Business, any type of online resource. You've got everybody throwing opinions at you. And right now it's at an extreme because everybody is trying to guess what the market's going to do with the whole virus over the next few weeks. I want to base my decisions off of price, off of the technicals. I can't control the news cycle. No one can. I try to filter as much of that noise out as I possibly can. Bottom line is everybody has an opinion of what they think is going to happen. And a lot of those people giving those opinions have trades on, right? They're managing money. They have an opinion based on what their portfolio looks like. Well, I don't know what their portfolio looks like. I don't want to be distracted by what they want to happen. I want to focus on what the market's telling me is going to happen. So I've got some moving averages on this chart, a mix of simple and exponential moving averages. I don't necessarily use these moving averages for entry and exit points, but it helps me determine how aggressive I want to be. When I get over to my individual charts in just a moment, those will be used to guide my actual entry and exit points. But I need to determine what type of options do I want to take these trades with? Do I want to use weekly or monthly options? Do I want to use just straight long calls and puts, or do I want to use vertical spreads? A lot of those decisions are made based on what my overall outlook is for the market. Well, last week, all my days are mixed up, not only with everything being shut down with the virus, but now you throw a shortened week with markets closed today and all my days are messed up. But so Thursday, looking at Thursday's close, notice the high on Thursday. Let me zoom in a little bit. You can see that we tested the 50-period moving average at the high of the session yesterday. It has been a phenomenal run off of the lows. Everybody's wondering now, are the lows in? Are we just going to continue grinding our way higher? Are we going to go back up and make new all-time highs? Markets very happy with what the Fed is doing. They are throwing trillions of dollars at the system to try to prop everything up. Markets love that. And it's not just billions of dollars, it's trillions of dollars. So no surprise that the market has rallied. But now the question becomes, we saw a big move lower. We have now recovered off of the lows. What happens next? I talked in last week's session how I was actually expecting the markets to make another leg to the downside. What I was not expecting was the massive actions that the Fed was going to take here this week. I mean, just phenomenal what they announced. So as a result, we did get one more leg to the upside, and now we are at a crucial area of resistance. That 50-period moving average right there around that 280 level. That's a key level that if we're going to stall out and get one more leg to the downside, now is the time going into next week. I would love to see us at a minimum get down and test the 8-period EMA. The 8-period EMA is that solid pink line. It's actually right on top of the 20-period moving average as well. So I'm looking for a test down towards that 264 to 264.50 level. I would love to see that tested here going into next week. you're looking at that saying, okay, that's a 14-point move lower on SPY. That's a pretty decent sized move. But in this market, it's not. I mean, we continue to see a lot of big range in this market. So we could see that tested within a couple of days going into next week. That would be a level that I would be interested in on the downside. If we break the 50-period moving average on the upside next week, the next area, we've got a whole cluster of moving averages above us up around the 290-ish level. That would be my next area to watch on the upside should we get a move to the upside. Volume continues to be very good. Thursday session, we closed around 190 million shares on SPY. It's a good number. I mean, for most of the last couple of years, up until the last 3-4 weeks, we were struggling to hit 40, 50 million shares on a daily basis. Now we're consistently up above 100 million shares. That's a good range to be in. However, it is lighter than what we saw on the downside. On the downside, we were seeing 250, 300 million shares trade. So we've started to see volume contract a little bit. For me, that indicates there's still uncertainty out there. That damage on the downside was enough to cause some doubt. People are not willing to jump in with both feet. I've been hearing a lot of people, dipping their toes in the water here, trying to put some money to work, but I'm not seeing a lot of traders getting aggressive on the upside. I think that shows in the volume contracting a little bit here on this wave to the upside. The VIX, over on the left-hand side of my platform, you can see the volatility. The VIX closed above 41 here yesterday, which is very interesting to me. We saw one of the biggest rallies over the past 2 weeks, one of the biggest rallies that we've seen in a long, long time. But yet volatility is still above 40. I would have expected volatility to contract more than it has. It's a little bit surprising to me. And I think that just goes to show that there is uncertainty out there. And that's why I continue to believe that we're going to get another leg to the downside here going into next week. I am not expecting us to get back down to the lows at 218 immediately. But again, a nice healthy pullback to the 8-period EMA like we just talked about, that could be very helpful as a springboard back up to another leg to the upside. If we just continue to grind our way higher here, I think it's going to be more difficult. The market's already made a heck of a run here. So I would love to see a pullback before another wave to the upside. And bottom line is there's still a lot of unknowns with this virus right now. The economy came to a screeching halt, and stocks have rebounded off of the hopes that the stimulus from the Fed is going to be enough. We just don't know here, right? I mean, this economy needs to get back up and running here very quickly, in my opinion. So next week is going to be a crucial week, not only from the virus headlines, but also from earnings season. We've got a lot of the financial stocks releasing their earnings next week. You've got Citigroup out on April 15th. You have got Bank of America out on the 15th. Goldman Sachs has their earnings out on the 15th. Very, very busy week. Add JP Morgan to the mix as well. Earnings out on the 14th. Next week is crucial. And we know the financials are a big part of the overall market. The market's going to take its cue from what the financials end up doing next week with their earnings releases. So I'm expecting a very busy week coming up next week. And I'll walk you through how I plan on approaching that here in just a second. So again, just to summarize, 50-period moving average on the upside, the high from yesterday, right around that 280 level. That's an area of resistance on the upside. Above that, you're looking at 290-ish as our next area of resistance. And then on the downside, if we do get some selling, the level that I am looking to have tested next week would be between 264 and 264.50. That happens to be the 8-period exponential moving average and the 20-period moving average. All right. So if I'm expecting a move to the downside, how does that impact my trading? Well, a couple things that I want to point out. If I go over to the trade page, and let's just go over and take a look at the options on QQQ, which is the NASDAQ ETF. And if we go out to the May monthly options with 35 days left, in a lot of cases, when you start to go out 20 to 40 days, on a lot of the index products, you're looking at options in a lot of cases between $250 and $500, depending on how active the market is. If you take a look at the current options that are slightly in the money, you're taking a look at options that are almost $1,000 a contract. Options continue to be very expensive and makes sense. With the VIX over 40, options are going to be very, very pricey here. And we talked about it last week in last week's recap. The problem that you're going to run into buying long calls and long puts here, they're very expensive. They're going to tie up a ton of capital, and because volatility is so high, let's say we come in and buy call options, expecting the market to move higher. You need that move to happen to the upside quickly, and it's got to be big enough to offset not only time decay adding up, but volatility decreasing. If the volatility continues to decrease, it's going to cause those options to lose value faster. Now, one way to combat that is to lower the cost of the trades is just to go to the cheap weekly options, right? Let's just go to the April monthly options that only have 7 days left. And let's go to the out of the money call and put options. Take a look at those out of the money options and you're able to lower the cost down to a couple $100. If I take a look at the 206 call, they're $200 a contract. The problem with those is they have almost a 70% chance of closing out of the money. They're cheap for a reason. They're cheap because they have a lower probability of success. What I don't want people to get in the habit of doing is just coming in and buying junky out of the money options. It may work in the near term because the range in this market is so big. Long term, it's not going to be a recipe for success. You're going to find it difficult to make that approach work. I would rather have you trade higher quality options, going out 20 to 40 days, going to the in the money options. Even though they're more expensive, you're going to have a higher probability of success long term. Now, if they're too expensive for your taste, you can turn it into a vertical spread. I continue to trade a lot of vertical spreads right now in my own personal trading. Because volatility is so expensive, the options are so expensive, it's a way for us to get more conservative. That's what I like personally. The markets are aggressive enough as it is. I don't feel the need to ramp it up even more going with the cheaper out of the money options. So we'll talk about some vertical spreads in just a moment. All right, let's talk briefly about a couple of the trades that we put on in these webinars the last few weeks. Some of you were with us last week, and we had talked about buying call options on the silver ETF, symbol SLV. And let's just quickly take a look at the chart. And we had talked last week about how our sentiment indicator, and let me reload this here a second. And we talked about how our sentiment indicator had flipped from bearish to bullish mode. And that was a big reason why we were taking a look at buying call options. So last week, we were taking a look at our sentiment indicator flipping from red to green. We also had price action up above our moving average. And it's that blue and red moving average. It's the 8-period exponential moving average that we have added. Oops, I'm sorry. I got to change the symbol here. We have added some custom formatting to that indicator to show you whether we are trending to the upside or to the downside. So we had our sentiment indicator go from red to green. We had price action up above our 8 EMA. That had us looking for a bullish trade. And last week in our webinar live, I had talked about buying the long calls, and I actually did so here in the webinar. We went out to the May monthly options, and we had bought the 13 calls. Right, so I'm highlighting those here on the screen. We ended up buying those options for $1.13, $113 per contract. It was an aggressive play. Buying a long call, it gives us a big profit potential, but I only make money if this ETF moves to the upside. It's a bullish play on silver. Fortunately for us, we have seen the metals, we've seen gold and silver move higher in a big way. These call options are now trading for $1.64. Right, so we've got a nice $50 profit per contract so far on this trade. How do we manage it? Do we keep the trade on? Do we take it off and book the profit? Here's what we're going to do. Anytime that I buy an option, my target is 100% return. I'm looking to double my money. My closing target on this one, because we got filled at $1.13, my target initially is $2.26. That's where I'm looking to close out of the options. That would give me 100% return. We're now trading at $1.64. So we're getting there, right? We're halfway there. So it's a nice trade so far. There's no reason to close it out as of yet. These May monthly options still have 35 days left to expiration. Plenty of time here. So I'm going to continue to hold. I'm going to look for another move to the upside here in silver going into next week. If you wanted to take part of your position off and book the partial profit here, book the $50 profit per contract, I wouldn't be opposed to that. but I do want you to keep at least part of your position on it, at least giving it a chance to hit that full 100% target. Going for that 100% target really helps our reward to risk ratio long term. That way we're not getting into the rut of all partial profits on the winners and full losses on the losses. I mean, that's just difficult to make that work long term. So if price action changes, if we see a reversal in silver next week and we see price action change on the chart, obviously that changes the ball game for us, and we could potentially consider closing out due to the chart pattern. But so far, going back over to the chart, we're still in bullish mode. The sentiment indicator is still green. Price action still firmly above the 8-period EMA. There is no reason for us to close it out here from a technical perspective. So I'm going to continue to hold silver. So far, nice profit on that trade from last week. We also talked last week about our XLE trade. This was actually from a couple weeks ago when we put it on here in our webinar. So we had looked at this chart and we had our pulse indicator, which is the red and yellow histogram down at the bottom. We had our whole slew of yellow bars here on the pulse. What does that mean? It indicates that price action is between a 1 and a 2 standard deviation move on the downside. In other words, we're very oversold. And in many cases, when you start to see that type of condition on the pulse, it'll typically lead to a period of consolidation or even a reversal in the other direction. In this case, a reversal to the upside. Well, notice what happened. When price action started to hit this extreme on the downside, the yellow bars started plotting. See what happened to price? It wasn't immediate, right? It didn't turn on a dime, but we started to see price action stabilize on the downside. We started to see it drift to the upside. That's exactly the pattern that we were looking for a couple weeks ago when we came in and we sold the put spread. Price action has continued to move to the upside, and let's talk about the trade from a couple weeks ago. Let me go back to the trade page and switch the symbol from SLV to XLE. And we had come in and sold the 26-24 put spread. So let me load up that trade down at the bottom. Just adjusting the strikes around here a little bit. When we put this trade on, we had collected 60 cents or $60 per spread. It only tied up $140 of capital per spread to put on. So a very reasonable trade cost-wise. Doesn't matter your account size. This was doable for anybody out there that has an options account. We collected $60 per spread. We wanted the price of XLE to stay above 26. The price of XLE at the close yesterday was just under 34. It's done exactly what we needed it to do. Now, the price is currently at 26 cents mid-price. On Thursday's session, this trade actually hit our 75% profit level. The 60 cents that we collected up front, that's the most I can make on the trade. But in order to make that entire 60 cents, I would have to hold all the way to expiration. I'd have to hold another 35 days on this position. Really wasn't something that I was interested in doing. Because the closer we get to expiration, the more reactive the options become to stock price. And if you hold too long, you run the risk of going from a nice profit to a loss immediately. I would rather book the profit while we have it, especially in this market that's so volatile. Let's book the profit, free up the capital, and move on to the next trade. Our target on a credit spread like this is always between 50 and 75% of whatever I collect to put the trade on. We collected 60 cents. So my target zone was anywhere between 15 and 30 cents. At the close yesterday, it was trading for 26 cents. It's still inside of our profit range. If you have the trade on going into Monday, you can close the trade out Monday morning and book the profit on the trade. It's going to be anywhere between a 30 and 45 cent profit per spread. So between $30 and $45 of profit per spread. So really nice trade. And again, the dollar number doesn't seem that significant, right? You're talking $40 of profit. But remember, you only tied up $160 per spread to begin with, right? I mean, so it's still a really nice return on your capital. And we had 5 ways of making money on the trade. We made money if XLE moved up, down, or sideways. As long as it stayed above 26, we were okay. We also made money from time decay adding up and from volatility decreasing. So it gave me 5 ways of making money on the position. So really nice trade. Again, if you've got the trade on still, I would recommend looking to close it out on Monday morning. And Bruce, I just saw your question. Bruce stating, I want to trade live now after learning for 2 years. I'm sorry, boss. I'm sorry. I read that as Bruce. My brain is fried here this week. Sorry, Boss Brown. Yeah, so we'd love to help you out. I mean, it's a great market. I continue to get a lot of questions from people asking, are we active in the markets? Are we going to the sidelines because the market is so volatile? It bothers me that so many people are concerned enough to go to the sidelines. As options traders, we want to take advantage of the movement. The volatility is a good thing. So it's a great time to get started. It's active, certainly, but there's money to be made, and it can be made in a safe way. Right? The trades that we talk about in our webinars here, they're all risk defined. We know what our maximum loss is up front. So yeah, well, actually, I'm going to transition here in just a moment. We'll take a look at a new trade setting up for Monday. So I'll give you a trade that you can put on first thing Monday morning. So let's do that now. If there's any questions on the SLV or XLE trades from the last couple of weeks, let me know. Go ahead and ask those in the chat, and I will circle back to those in just a moment. So let's go over to the trade that I want to walk through for today. It's a trade that you can potentially grab Monday morning as well. I normally like to place these trades live in these webinars. I'd like to show you guys how to do it and see that, so you guys can see that we're actually trading on our side. Markets are closed here today, so we can walk through this trade. We'll get it all queued up. I was actually able to place this trade yesterday afternoon along with many of our students. But there's a very good chance that you can grab it Monday morning as well. So I'll give you all the information that you need to place a trade Monday if you want to. So this is symbol EA. This is Electronic Arts. It's one of the few names out there that has actually gotten through this whole downturn in the market pretty well. You can see on the chart, it's actually hung in there. You're not seeing the big drawdown like we're seeing on some of these other products. So as a result, and let me make one quick adjustment here. Just bear with me here a second, guys. There we go. All right, so I want to shift your focus again to the pulse indicator down at the bottom. It's the red and yellow histogram. Notice how over the last week or so, we got to an overbought extreme. How do I know that? How do I quantify it? Anytime that I get the yellow bars on the pulse indicator, it indicates that price action has now reached between a 1 and a 2 standard deviation channel move on the downside. I'm sorry, on the upside. We're overbought. It doesn't mean price can't move higher. It just means that we're at a level now that historically speaking typically leads to a period of consolidation or a reversal to the downside. Now, I don't want to just come in and be 100% bearish here. I don't want to just come in and buy long puts. The problem with that approach is I would only have one way of making money on the trade. I would need EA to move to the downside, and it would have to do so in a big way, and it'd have to happen quick enough. If all of that doesn't line up in our favor, I'm potentially going to lose money on the trade. So I'm not looking to be that aggressive. Not to mention the options are pretty expensive right now too. We already just talked about that with volatility being so high. Because price action is at an extreme, Thursday afternoon, we had started to see price action break down below our 8 EMA. It led me to look at a neutral to bearish position. I want to lean a little bit bearish, but I want to do so in a safer way. So let's jump over to the trade page and I'll walk you through how to do it. All right, so we are going to consider the May weekly options with 21 days left. I've talked in these sessions the last few weeks about how in many cases we like to use the options with 20 to 40 days left. Even though our holding times have been a lot shorter here recently, going out 20 to 40 days gives us a little bit of a cushion. If I trade the options and only have 7 or 14 days left, it's a little too aggressive. If that move doesn't happen in our favor immediately, we're in trouble faster. By going out 20 to 40 days, it gives us a little bit of a cushion to hold the trade longer and potentially adjust the trade if needed, if it goes against us initially. Well, going out to the May weeklies with 21 days left, let's go ahead and open those up. We wanted to take a look at selling a call spread. Now, selling a credit spread, a lot of times people get intimidated with this trade. They think it's more advanced. They think it's going to take up more capital. it's actually one of the safest trades you can take. It's actually much safer than just buying a call or a put. There's a lot of misinformation out there. People avoiding these trades because of thinking they're too risky. In this market, with volatility so high, it's actually a trade that's going to better take advantage of the current conditions. So let's go to the out of the money calls. I'm going to go to the 108 calls. I'm going to right click on the 108 calls. I'm going to go to sell, and I am going to select a vertical from the drop down menu there. So select vertical, and it's going to pop up an order down at the bottom. It has me selling the 108 call. And by default, it has me buying the 109 call. I'm actually going to change that 109 call to 110. So I'm going to click on the drop-down menu, switch it from 109 to 110. Why am I making that adjustment? Ideally, I want to put on a spread where I can collect between 30 and 40% of the width of the strikes. By stretching that from a $1 wide spread to a $2 wide spread, it allows me to collect more premium. Gives me a little bit more juice in the spread, gives me a bigger profit potential. This one is trading for 76 cents mid-price. If we get filled there Monday morning, that allows us to collect between 30 and 40% of the width of the strikes, right? 30 to 40% would have me looking at between 60 and 80 cents. So it meets my criteria. If I click on confirm and send, I would be in a situation where I'm risking $124 to make 76. It's a very normal range for us. And in many cases, we're risking between 2 and 3 to make 1. We're actually slightly better than that here in this case. I'm willing to risk more here to make less. The reason I'm okay with that is we have 5 ways of making money on this trade. Here's how it works. My break-even point would be at 108.76. That break-even point, they are calculating that by taking this option that I'm selling, the 108 call, and they're adding on the 76-cent credit that I would be collecting to put the trade on. I don't care if the stock moves up, down, or sideways. As long as it stays below 108.76, I'm okay. The closing price yesterday on EA was at 105.80. I have almost a $3 cushion that this thing could move to the upside, right? So I've almost got a 3% cushion here that I can be dead wrong and still make money. The only move that hurts me is a big move above 108.76. I'm not expecting that because we just took a look at the chart and saw that the pulse indicator is overbought. The pulse indicator was plotting yellow, indicating that we're at an extreme. So I would love for EA to move to the downside. In fact, if it moves lower, I'm going to make money on this trade faster. I just don't need it to. If we just chop sideways here, if we drift to the downside, I'm okay. If we move to the upside, I'm okay. The only directional move that hurts me is a big move higher above 108.76. So up, down, or sideways, we're okay all 3 ways. We make money every day that passes. The time decay helps me. So the time decay is the 4th way that we have of making money. And I make money if volatility decreases. I'm expecting it to continue doing that here over the next few weeks. The volatility market-wide is still very high. Historically speaking, it's at a level where it doesn't typically stay this elevated that long. So I'm actually expecting volatility on EA to continue contracting here over the next couple of weeks. If it doesn't, that's okay. We still have 4 other ways of making money on the position. So up, down, or sideways, time decay helping us, and volatility decreasing. Those are the 5 ways of making money on the position. Now, let's say for our example here, you get filled at 76 cents on Monday. Where is the target zone? How do we manage the position? The 76 cents, the $76 per spread, that's the most I can make on the trade. That's my max profit potential. The only way that I can keep the entire $76 is if I hold all the way to expiration. That's not something I want to do because the closer we get to expiration, the more sensitive the options are to changes in stock price. We could be profitable for the first 16 days of this trade, and then in the last 5 days, if price action reverses, I could go from a nice profit to a loss almost immediately. I don't want that to happen. I would much rather close this thing out when I can keep between 50 and 75% of the max profit. So if I can close it out between 19 and 38 cents, that's exactly what I want to do. So if I put this trade on Monday morning, I could create a closing order immediately to buy the spread back for between 19 and 38 cents. I would start out at 19 cents myself. That way, everything is in place. I don't have to sit there and watch the chart all day. I don't need to look at the markets all day long. I can get my orders in place, move on with the rest of my day. Okay, so you look at this one, $76 of profit potential. It's a game changer. Is it a home run profit potential? No, it's not. I'm giving up the home run profit potential in exchange for having 5 ways of making money on the trade. It's going to give me a much higher winning percentage when compared to just buying an outright call or put. But I'm only tying up $124 of capital to begin with. So you take a look at that, and it's actually a fair trade-off. I'm giving up my home run profit potential, but in exchange, I have much less capital at risk. If you've got a bigger account size, sure, you can put this on with multiple contracts. Put it on 10 times, and you still only have $1,200 of risk. So you're not locked in to just trading it with one contract or one spread. Now, let's just compare it. If I were to come in and let's just say I wanted to lean bearish, but I wanted to compare selling a call spread to buying a long put. They're both bearish positions. If I were to come in and buy an in-the-money put, if I go to the 107 puts, you're talking about $500 a contract. Right? You're talking about 4 times the amount of risk on the trade when compared to selling the call spread. So it ties up more capital. Yes, you have a bigger profit potential, but you only have one way of making money. EA better move to the downside immediately. Otherwise, that long put is going to be in trouble faster. So that's why I lean towards the short call spread here. It allows us to take advantage of the higher volatility in this market. Gives me 5 ways of making money on the trade. So it's a more forgiving trade. We've seen big moves back and forth in this market, guys, right? I mean, it's been all over the map. The vertical spreads, specifically the credit spreads, are going to be more forgiving. And in this market, that's something that I want to take advantage of. Now, what we just talked about on EA, you can follow that whole approach on any stock on your list, right? You go to Apple, you go to Amazon, Facebook, you can follow that same criteria. Go out 20 to 40 days to expiration. Try to collect between 30 and 40% of the width of the strikes. So in this case, there's a $2 difference. So I wanted to collect between 60 and 80 cents. That's exactly what we were able to do. You can follow that same criteria on any stock or ETF that has options available on it. You can also flip it around. We wanted to look at a neutral to bearish position on EA. What if you have an exact opposite outlook? Maybe you're saying, hey, Mike, I mean, the bulls are taking over. The Fed is printing money like crazy. This market's going higher. If that's your opinion, I have no issue with that. You can just take a look at selling put spreads. Just flip it around. Go in and take a look at selling an out of the money put option or a put spread. Still go out 20 to 40 days. Still look to collect between 30 and 40% of the width of the strikes. And if you do that, you're able to put on a neutral to bullish position. So it does not matter to me what your outlook is. That's the beauty of trading options. You have a lot of flexibility to put on trades that really respond and reflect what your outlook is for the market. All right, any questions on the EA trade for this week? Any questions on any other markets that you're taking a look at going into next week? Again, for those of you that weren't able to catch the beginning, my outlook, because we hit a very key resistance point on Thursday to wrap up the week, I am actually looking for another wave lower here going into next week. I would love to get down and test the 8 EMA down around 264.50. So that's what I am expecting going into next week, but we'll just have to wait and see what happens here. Boss Brown, I don't trade the currencies. I'm not a big Forex trader. I focus exclusively on options trading. It doesn't mean the Forex markets are bad. I just think they're more difficult to make money in. That's why my preference is to trade options. So I just can't give an opinion on any of the currency markets. I just don't really trade those. I trade some of the currency ETFs, but I just don't trade the spot markets directly. And let me have one link for you guys here. So what we decided to do coming up this next week on the 15th and 16th, we are actually going to be hosting a live 2-day training. It's going to be absolutely free of charge. Okay, there is no cost to attend. And what we wanted to do, because we know that there's a lot of people that have had their jobs lost, right? I mean, people are getting laid off, and it's difficult. in this environment. It's difficult to pay bills and whatnot. We want to try to help as many people out as possible. What we're going to do coming up next week on Wednesday and Thursday, we're going to open up our entire options toolbox. So what I just got done talking about here today, we're going to go through that in greater detail at a slower pace. We're going to basically talk through how to open up a brokerage account, how to identify the trades, how to take those trades from start to finish, and utilize some of our favorite options strategies. So let me get the link in the chat here. It's going to be at 12 o'clock Eastern on Wednesday and Thursday next week. And I'll get it up on the screen right there. So it's netpicks.com/options crash course. Again, completely free of charge. There's no financial commitment on your end. Join us. You can watch us trade live. We'll answer any questions you have in real time. So again, Wednesday and Thursday, 12 o'clock Eastern, both days. We'd love to have you join us. Even if you can't attend live, still register for the training because we will be recording and we'll send those trainings out to you. All right, so we'd love to have you join us. All right, so I'm going to start to wrap up here for the day. Hopefully you guys were able to join in on the XLE and SLV trades. I heard from a few of you that were able to the last couple of weeks, so congratulations to those of you that did. And then we'll see what happens on EA. If you have any questions on the EA trade on Monday when markets open again, certainly let me know and can get in touch to help out right away. So enjoy the long holiday weekend. Enjoy having a Friday off for all of you that are active in the markets. And I'll be back next week with our next live update. So enjoy the weekend, everybody. We'll talk to you next week.